Types of mutual funds based on structure. These are funds that are characterized by their structure. Open-ended funds. These funds let investors buy and sell units anytime, offering liquidity. They are popular for those seeking flexibility in entry and exit, making them suitable for long-term wealth creation. Closed-ended funds. These funds have a set maturity and a fixed number of units. Investors purchase units only during the initial offer and can trade them on stock exchanges. They cater to those interested in long-term investments with potential tax benefits. Interval funds. Interval funds combine the features of open and closed-ended funds and allow periodic redemption at specific intervals. They appeal to investors looking for a balance between liquidity and long-term investment. Types of mutual funds based on risk factors. Very low-risk funds, liquid and ultra-short-term funds, 1 month to 1 year, offer low risk and modest returns, around 6% at best. Investors use these funds to achieve short-term financial goals while keeping their money safe. Low-risk funds. During rupee depreciation or national crisis, investors may hesitate to invest in riskier options. Fund managers suggest liquid, ultra-short-term, or arbitrage funds in such cases. These funds typically offer returns of 6 to 8%, and investors can switch when market conditions stabilize. Medium-risk funds. Medium-risk funds balance investments between debt and equity, offering a moderate level of risk. The NAV remains relatively stable, with average returns ranging from 9% to 12%. High-risk funds. High-risk mutual funds suit investors comfortable with volatility and seeking substantial returns through interest and dividends. Active management and regular reviews are essential, with potential returns of up to 20%. Specialized mutual funds. Sectoral funds. Sector funds focus exclusively on specific sectors of the economy, making them theme-based investments. Due to their concentrated holdings in a single sector, they carry higher risk. Investors should monitor sector trends closely. However, sector funds can also offer significant returns, particularly in sectors like banking, IT, and pharmaceuticals, which have shown consistent growth and are expected to continue performing well. Index funds. Index funds are suited for passive investors as they track an index rather than being actively managed. By mimicking index performance, they aim to match rather than beat the market, providing a stable investment option. Fund of funds, funds of funds, or multi-manager mutual funds offer diversification by investing in various funds within a single portfolio. This approach reduces costs while achieving broad market exposure. Emerging market funds involve investing in developing economies, which can be volatile but offer the potential for high returns over the long term. These markets contribute significantly to global growth prospects. International funds. International or foreign funds appeal to investors seeking diversification beyond domestic markets. They can be approached through different strategies, such as hybrid allocation, feeder funds, or theme-based investing. Global funds. Global funds differ from international funds by including investments worldwide and domestic markets. They provide a diverse investment approach but carry risks due to currency and policy variations. Real estate funds. Real estate funds provide indirect exposure to real estate markets through investments in established companies or trusts, offering liquidity and risk mitigation compared to direct property investment. Commodity funds. Commodity-focused stock funds suit investors looking to diversify into commodities. These funds invest either directly in commodities like gold or in shares of commodity-related companies. Market-neutral funds. Market-neutral funds aim to provide stable returns by hedging against market volatility, appealing to investors seeking consistent performance. Inverse funds. Inverse or leveraged funds move opposite to benchmark indices, offering potential gains during market downturns. They involve selling and repurchasing lower-priced shares to profit from market movements. Asset allocation funds. Asset allocation funds combine different asset classes like debt, equity, and gold based on market conditions, offering flexibility and risk management. ETFs, exchange-traded funds, ETFs, track indices and are traded on exchanges, providing real-time trading opportunities and extensive market exposure. Section 80C of the Indian Tax Act allows taxpayers to claim deductions up to 150,000 rupees from their total annual income, providing tax relief. Gilt funds. Gilt funds are a type of debt mutual fund that primarily invests in government bonds. They are also known as GSECs or government securities.